In a surprising twist, the 30-year fixed mortgage rate rose to 6.61% this past week, up 25 basis points from just a week ago, even as the Federal Reserve announced another rate cut. How can mortgage rates rise when the Fed is actively lowering rates? I'm Eric with Andersen Realty Group, and in this video, we'll look at what's going on. When the Fed cuts interest rates, it's reasonable to expect borrowing costs to drop, including mortgage rates. But that hasn't been the case, as we saw this past week. Why would mortgage rates go up after a Fed cut? Today, we'll explore why mortgage rates don't always follow the Fed's actions and what this means for the housing market. This week, the Federal Reserve lowered its benchmark rate by a quarter point. These cuts are designed to make borrowing more affordable, yet mortgage rates are climbing instead of falling. For home buyers, this disconnect can be especially frustrating as they're trying to budget for a new home. It's important to understand that mortgage rates aren't directly tied to the Fed's rate. Instead, they respond to a wider set of economic forces that go beyond the central bank's immediate actions. To understand what's happening, let's start with the bond market. Mortgage rates are closely linked to the yield on 10-year Treasury bonds, which act as a barometer for long-term expectations about the economy. When investors sense stormy weather coming, things like high inflation, they demand higher returns on bonds, pushing yields higher. This past week, bond yields went up, and so did mortgage rates. At the Fed's December meeting, policymakers announced their third and final rate cut for 2024. But the real headline was their updated projections for 2025. Back in September, the Fed expected to make 4 rate cuts in 2025. Now, they're only projecting 2, and the markets responded about as well as telling your toddler it's bedtime, or no more candy, or pretty much anything they don't want to hear. The Fed was signaling that they plan to keep rates higher. Why? Inflation remains sticky. In November, it came in at 2.7%, still well above the Fed's target rate of 2%. Their cautious approach sent a clear message. Future rate cuts won't come as quickly as the markets had hoped. As a result, Treasury yields and mortgage rates moved higher. What confuses people is that the Federal Reserve doesn't set mortgage rates directly. They influence them, but they do not set them. While rate cuts lower the cost of short-term borrowing, mortgage rates reflect long-term expectations about inflation, economic growth, and investor sentiment. The Fed's December meeting signaled a higher for longer stance, which rattled the bond market and drove yields higher. Mortgage rates are shaped by how the market interprets the Fed's signals and the broader economic landscape. The Fed's impact on mortgage rates then is indirect. What does this all mean for the housing market? Mortgage rates play a key role in the housing market because they have a direct impact on affordability. When rates rise, monthly payments for new borrowers gets more expensive, and it reduces how much home they're able to afford. So imagine a buyer who was approved for a $500,000 home when rates were 5%. With today's higher rates, that same buyer might only qualify for $450,000. Higher rates reduce what buyers can afford, and this often slows down demand, especially for first-time buyers or those on a tight budget. On the seller side, rising rates can discourage homers who are locked into lower-rate mortgages from listing their homes, further restricting inventory. Ironically, higher rates can then actually increase home values as limited supply keeps prices elevated. So to sum up, The recent rise in mortgage rates is a reaction to the Fed's cautious outlook for 2025, as well as persistent inflation concerns. Mortgage rates are driven by a number of complex factors, including bond yields and market sentiment, which extend well beyond the Fed's immediate actions. While the Fed's rate cuts may dominate the headlines, and that may sound like great news, it's the market expectations about the future that will determine what will happen with mortgage rates. What are your thoughts about the Fed's cautious approach and their impact on mortgage rates? Let me know in the comments. And if you want to stay current on the housing market in Burr Ridge and the western suburbs of Chicago, be sure to subscribe to my channel, turn on notifications, and check out my other videos. I'm Eric with Andersen Realty Group, a family-owned brokerage where we treat our clients like family.